Hello family, welcome back. Today we are going to discuss an update that the FHA just put out last week that will benefit a lot of potential home buyers, and you could be one of them. So stick around. For those of you with student loan debt and have either tried to get qualified using an FHA loan, or if you're presently qualified with an FHA loan but have student loan debt, this update is for you. But before we get started, I want to say welcome to the channel. My name is Sir Ashley, and on this channel we talk all things real estate, money, and in certain videos we talk about the state of North Carolina. So if you haven't already, go ahead and hit that like button. Also tap on that subscribe and bell notification so you can be alerted for when we drop new videos. But let's go ahead and jump right into the content of this video right here. So if you've applied for an FHA mortgage and have student loans, you know that if your student loans are deferred or on an income-based repayment plan, an IBR, the lender would have to automatically use 1% of the student loan balance to qualify you for a loan. So I have a lot of friends and colleagues who have, don't judge them, but they have over $100,000 in student loan debts. Look, undergraduate and grad school and law school just aren't cheap nowadays. First, let's give a quick example of how the old rule used to work. And then we'll talk about the new rule and give an example of how it will work today moving forward. So using the old rule as an example, if a person had $100,000 in student loan debt, but had an income-based payment plan, an IBR, that was $250 a month, regardless of the payment plan, under the previous FHA guidelines, the lender had to put down $1,000 a month in student loan payment because that was 1% of the loan balance, even though that person was only paying $250 a month. Now that previous guideline by the FHA, using 1% of the student's loan debt, has obstructed thousands of people from being able to qualify for a loan. And I personally have worked with more than 30 plus people over the years that could not get qualified or approved for a mortgage because their student loan debt was too high. And yes, I'm talking about people with good credit and good jobs. Their only impediment was their student loan debt. Well, the rules have changed and effective immediately. If you have student loan debt and want to buy a home, it has gotten 10 times easier for you. You see, under the new FHA rules, the lender no longer has to calculate 1% of the student loan balance into your monthly debt to income ratio. The new rule states that if you are in an income-based repayment plan, IBR, the lender will use whatever that monthly amount is. It doesn't matter if your monthly payment plan is $5 a month. That is the amount your lender will use when calculating your debt to income ratio. Look, this is a game changer, a serious game changer. And when I first heard about this, I automatically thought of 5 people that could greatly benefit from this new rule change. Now, the second part of this new rule are for those that have student loan payments in deferment. Now, if your loan is in deferment, the lender will use 0.5% of the student loan balance while determining your debt to income ratio, as opposed to the 1% of the student loan balance that they were using prior. Now, if we're going to use the 0.5%, let's look at some number examples on how that could play out. Now, since the new rule is looking at 0.5%, let's play that out in the example we were using. Let's say you have $100,000 in student loan debt. Now, under the previous guidelines, the lender had to use $1,000 a month or 1% as going against your DTI. But under this new rule, the lender will be using 0.5% or $500 a month going towards your DTI. So that would make the impact on your student loan when calculating your debt to income $500 less. That is significant. Cutting your student loan balance or repayment in half has a significant impact on your debt to income ratio. Let's use an example that probably is more common for most people. Let's say you have a student loan balance of $50,000, but your loan is in deferment. Well, the lender will not use $500 as your debt to income ratio when trying to configure your student loans. They will only have to use $250 when calculating your debt to income for your student loan repayment. Also, if your income-based payment is $0, lenders will then default to use the 0.5% formula we just spoke about. So as I went through this, I think this is the best route moving forward. No matter what your situation is, if you're using an FHA loan and have student loans, you are going to want to get your loans out of deferment and get an IBR, an income-based repayment plan. And you're going to want to get that payment plan as low as possible. Now, I don't know your particular finances, but if you're looking to get a home or a home loan using FHA, it's prudent to get your loan repayment plan as low as possible. Look, you can always make additional payments or pay extra, but when lenders are calculating your debt to income ratio, it's better for you if you get that payment as low as possible. And you can get that income-based repayment number very, very low. Now, if I remember correctly, after graduating law school, while studying for the bar, but before I passed the bar, I had to start making student loan payments. And it was based on my income. And my student loan payments were as little as $5 a month. Yes, $5 a month. You too can make that possible. So do whatever you need to do. Call your student loan provider and get your income-based payments as low as possible. Just imagine what a huge difference this would make. Under the previous rule, if you had $100,000 in student loan debt, the lender had to calculate $1,000 every single month against your debt to income. But now, if you are in an income-based repayment plan, and let's say you're making a $50 a month payment, the lender will look at just the $50 a month. So in the eyes of the lender, you just got a $950 a month raise. So you're able to qualify for a higher purchase price of a home. And that could make a huge difference in living in an area that is to living in your desirable area. And it also makes a huge difference when we're talking about competition. There is a lot of competition for the median priced home. Here in Charlotte, where I am, the median priced home is anywhere from $300,000 to $350,000. And there's tons of competition right now for properties in that price range. But under these new guidelines, you may be able to get approved for a higher price mortgage. That way you're able to beat out or not have to deal with the competition. I know some of you come to my channel for North Carolina and Charlotte specific stuff, but no, this is not a state or area specific rule. This is a new rule regarding FHA loans and student loans. And it's coming from the Department of HUD and is available for everyone looking to buy a home in the greater United States. So you may be asking, what are the next steps and what does this mean for buyers and sellers? Well, the next steps are as follows. The number one thing you want to do is get your student loans in an income-based repayment plan. Now, again, I don't know your particular situation, but I advise you to get that payment as low as possible. The second thing you should do is if your loans are in deferment, see number one, get them in an income-based repayment plan. And the third thing you want to do is get documentation of this new agreement. Get a letter from your student loan provider stating the payment arrangement that you're making. Then I want you to contact a mortgage lender. If you're in North or South Carolina and don't have a mortgage lender or mortgage broker you're comfortable using, you can reach out to me and I'll put you in contact with one that I know and trust. Next, for those of you who are already pre-approved with an FHA loan, contact your lender and have them run your numbers again. More than likely, you will be pre-approved for more money and at a higher purchase price now that these new rules went into effect. Now, let's talk about what this new rule means for both buyers and sellers. Well, if you thought the housing market was crazy before, it's about to reach new heights of craziness. For the past 1.5 months, almost 2 months, I've been telling you that things, while they're going fast, they started to slow up a bit. And homes started to sit on the market for a couple days, and every home was not getting 15 to 20 offers like they were in March and April. And that was evidenced in the fact that mortgage applications for new home purchases actually decreased for several weeks during the past 1.5 months. Well, buyers, I pray that you listen to me because things are about to change. There is about to be a flood of buyers who could not get approved before, but because of this new FHA rule, they will be able to get approved, and those that were able to get approved will be able to get approved for more money. And I'm talking about well-qualified people with money to spend. Only thing is, they could not get over the hurdle of the debt to income ratio due to their high student loans. So my advice to you is to act quickly and decisively if you're in the market to buy a home and take advantage of these interest rates right now. Because quick teaser, based on the notes from the Federal Reserve last week, these low interest rates may not be here as long as we initially expected. So lock in these low 30-year fixed rate mortgages while you can. Also, banks are beginning to tighten up on some lending standards, so you want to act fast before you're negatively impacted by that as well. Now, I'll be going in depth regarding both of those topics and many others in my monthly market update that I'll be putting out later this week. So be sure to like this video and tap on the subscribe button so you can be alerted for when that video comes out. Also, be sure to reach out to me if you have any questions. I'm Sir Ashley, your real estate advisor, and I'm licensed in North Carolina and South Carolina. Talk soon.